Stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by.
Welcome to today's meeting of the Housing Committee. Members of the public may like to follow at London Assembly on social media and use the hashtag London Housing for this meeting. Please may I remind participants to silence your devices. Our main item of business this afternoon is a discussion on financing housing in London. Before we begin, we have a few short items of business. Can I now ask our clerk, Diane Richards, if any apologies have been received?
Thank you, Chair. Apologies have been received today from Assembly Member Boff and also from Assembly Member Cooper, for whom Assembly Member Baker will be substituting today.
Thank you. And Assembly Member Baker is in a separate briefing. She'll be joining us shortly. So can I ask the committee to... to note the recommendations set out at item 2 and ask if members have any other interests to declare. No? OK, great. Can we confirm the minutes of the meeting held on the 26th of February 2025?
Agreed.
Can we note the completed and outstanding actions arising from previous meetings?
Noted.
Can we note the recent action taken by me as Chair under delegated authority in consultation with party group lead members, namely to agree the committee's response to the Mayor's intermediate housing consultation?
Noted.
Okay. Thank you all for your contributions to that as well. So that brings us to our main item of business for today, which is financing housing in London. Really important point. We've got 1.5 million new homes to build across the country and thousands across London. So this afternoon's panel will be split into... This afternoon's discussion will be across 2 panels. Apologies. So the first panel would like to welcome all of you. I'd like to introduce Will Jeffwitz, Head of Policy at the National Housing Federation, Josh Ryan Collins, who's a Professor in Economics and Finance at UCL Institute for Innovation and Public Purpose, and Steve Partridge, Director and Head of Housing Consultancy at Savills. So welcome to you all. So I will take the first couple of questions, but I wanted to just ask you a bit of an explanatory question for my own knowledge, really. So if one of you could very briefly explain amortising grant, what that is, I'd be very grateful. So to make sure that I've understood it properly, and perhaps people watching might kind of understand that. Perhaps maybe we'll go to you, Will.
Hi, afternoon. I can have a go. I might also see if Steve wants to chip in on that as well. I mean, amortiser, it's an accounting treatment. It's where you treat grant in accounting terms, and it means you spread out the kind of rather than kind of booking it all right at the start when you get the money, you spread it out over the lifetime of the asset that it is funding. So grant for social housing, for example, you kind of drip feed that grant through your accounts as that social home is in existence over 20, 30 years, however you want to account for it. That is my understanding. I don't know if Steve or Josh want to...
Well, yeah, by way of example. So, for example, the GLO or Homes England might provide grant and make an assumption that it would have a 60-year life. So if the grant was £120,000, then the Housing Association or local authority would write it off at £2,000 a year over the 60 years.
OK, so I did understand it properly. Thank you. It's also going to be a bit of an economics lesson for all of us. So my first question to all of you is, in what way does the housing sector currently utilise private investment, and what are the limitations and risks? So perhaps we'll start with Steve and work our way across.
Just to set the scene, thank you, Chair. I guess the single most obvious route for private finance into particularly affordable housing, but also wider rented housing, is through debt. Debt in two directions. One, development finance to effectively get the homes built in the first place, and then once built, a longer-term investment debt, which is kind of set out over 25, 30 or however many years. But increasing, and debt forms the overwhelming majority of funding for private funding for housing associations and for increasingly for build-to-rent developers. We are seeing an increase in what's called equity investment, or people might call it private equity. That's not quite right. It's kind of equity investment, pension fund investment, private investment in the widest sense, which isn't debt as in a loan, but it is an investment in either shares or in the property in order to provide funding for affordable housing and for rented housing. And it's that growth in equity investment that people talk about when we talk about bringing in pension funds, bringing in that kind of the new money or the new capital and private capital. It's not a majority sport at the moment, but it is on the rise, and there is a very great appetite for equity investment and to deploy equity investment in new housing across the country and across London. So when you hear about pension funds, the local government pension fund or local government pension scheme, you hear about for-profit RPs, these are all these are all using equity investment and those new forms of private capital. And I guess we can have a discussion this afternoon about how well that's going, what the opportunities are, and what the barriers are to bringing in that type of capital.
Thank you. If we can go on to Josh and then Will, and then Lord Bailey, you can come in afterwards with your follow-up.
Thanks. Yeah, no, I should first say that I'm not an expert on this specific topic. So I'm a macro economist really, and have looked at the housing, the UK housing market in fairly broad perspective, and what the drivers of affordability are. But what I would say is that I think there is quite a big question, sort of fundamental question, over whether the provision of social, genuinely affordable housing is an activity that can generate a profitable return. There is quite strong arguments to say that it's not, that it's fundamentally a public good, and that efforts to try and create business models that enable the leveraging of private sector investment into affordable housing may not work. Now, it's early days to kind of make claims one way or the other in this country, I would say. Private sector, build-to-rent sector, for example, which a lot of people are getting excited about, is still quite a small percentage of the total stock. But there are some slightly concerning examples, I think, that illustrate the potential problem. If we just think about a couple of examples, one is the example of Wembley, where a huge amount of private investment has gone into the build-to-rent sector in the sort of Brent area, and it's actually the area where the single largest build-to-rent scheme is planned, and should complete with 6,000 units quite soon. Brent's actually delivered the second most new homes of any London borough between 2020 and 23. Now, private rent inflation during that period was a bit lower than the London average. But since the beginning of 2024, this is I'm reporting here on research by Commonwealth, a recent report that just came out last month. Rent increases have massively outstripped the UK's PRS sector and also the London average, rising by 34% from the year to July 2024. It's hard to tell how much of that is just driven by having a lot of very high-end new build-to-rent stock in place. But there is evidence that many institutional investors, I mean, the firms behind developers and the investment companies behind these types of schemes, their objective is to generate, double-digit returns on equity. Ultimately, they have shareholders, they have an obligation to provide competitive returns, and the strategies they use may not be very compatible with actually meeting housing need in London. So the operator of Wembley Park, Quintain Limited, is a subsidiary of Lone Star Funds, a Dallas-based private equity firm, and reporting on their operations in the US market suggest a pattern of intentionally pursuing foreclosure of homeowners, failing to offer sustainable loan modifications, and aggressively driving up evictions. That's just a quote from a Chicago newspaper. Essentially, the business model of some of these firms, Blackstone is in many academic papers, is that they come in, buy up, they come into an area where there's what's called a rent gap, i.e. rents are lower than they are in maybe the surrounding areas. They come in, they make maybe some improvements to the stock, but they can be quite aggressive in trying to move on people paying below market rents so as they can maximise the rental yield. And then often the business model is to actually sell the asset within 6 or 7 years with having evidence this increase in the yield from when they purchased it. So the problem with that business model, obviously, is it's not going to provide the solution to the massive need for more affordable housing that Londoners require. There's another example from Greater Manchester that I wanted to share, where there's, again, been a huge amount of build-to-rent investment. This is research looking at the impact between 2012 and 2020, where just 471 affordable homes were built in the city centre, of which 192 were with developers via Section 106, out of a total of 45,000 units in that period. In other words, 1% of the homes provided by this by build-to-rent investors were affordable. And this is despite Greater Manchester Council significantly relaxing affordable housing requirements, just as the London Mayor has done in the latest London Housing Plan in terms of obligations. So I think it's just a case of thinking about kind of, rather than saying the only option is to leverage in more private finance because we don't have enough money, I think we sort of need to take a balanced view on, of course, we need some private finance for mixed developments, but if the prime objective here, if the prime need is more affordable housing, I think we need to be thinking about some other types of options. So I'll leave it there.
Okay, thank you very much. We will come back to that. Before I come to you, Will, and you, Lord Bailey, Steve, you wanted to come back?
Yeah, I mean, without wishing to kind of court controversy at this end of the table, Chair. Well, I mean, I think there is a role for this type of private finance and equity investment, and particularly in the context of long-term investment into affordable housing. So, Josh has described a situation on build-to-rent where there's more flexibility about what you do with your assets once you've built them. Obviously, with affordable housing, they're there for the long term. If they're regulated, they're under the Housing Association, local authority, or the for-profit. They can't be anything other than affordable housing. They need to stay as affordable housing. So when Josh talks about the build-up of a portfolio and an exit in order to earn a big return, that isn't necessarily a challenge in the round if that housing is provided for the longer term. So if it's helpful for committee members to think of, you mentioned Blackstone, they've invested through Sage Housing. They are an investment fund looking for high returns. They're generating those returns through building a portfolio, developing new homes, and then selling to a long-term investor or a pension fund. And so there's nothing particularly challenging about that model if it delivers more affordable housing than there would have been already. Now, Sage, as an example, has 22,000 homes in ownership or pipeline across the country. One should ask the question, would those 22,000 homes have been financed and built and developed had it not been for Blackstone and Sage? So I'm not saying by any means that this is the only solution, but it is certainly part of the picture. And just for the benefit of committee members, in the long term, the investment in affordable housing, index-linked, low-risk, inflation-driven returns are very compatible with long-term pension fund investment. So this is what we call liability matching. So pensions are paying out inflationary pensions over here, and they're investing inflation in inflation hedged generating assets over here. And in many ways, what better way for liability matching from a local government pension scheme than investing in affordable housing to generate those returns? Those returns are by no means incompatible with the delivery of affordable housing.
Thank you. That's really helpful. Will, would you like to come back?
Thanks, Chair. Yeah. I guess as by way of sort of introduction and background, so I'm the Head of Policy of the National Housing Federation, so we're the trade body for housing associations in England, so our members are not-for-profit providers of social housing, about 600 across the country, vary very widely in terms of size and specialism and geography and everything else. But I guess the thing they all have in common is that they are not-for-profit charities, and their main sort of charitable objective is providing social housing. And I wondered, just one thing to be clear on, I suppose, is that what I'm going to talk about is social and affordable housing. Build to rent, which I know we're interested in as well, is obviously not a social affordable product. That's a market product. So the build to rent kind of debate to some extent looks a bit different. But I'm going to talk about social and affordable housing. And hopefully it is useful, and I'm not just saying things you already all know, to quickly go over the sort of funding model for social housing in general, just so we can see how the private funding fits in. So, crudely, the way you fund social housing is firstly you borrow, or you could use equity investment, but predominantly you borrow as much as you can against the future rental income that house is going to provide. But because that rental income is sub-market, because it's social rent, so social housing, that amount you can borrow is not enough to actually build the home. So you've got a gap, and you have to fill that gap with subsidy. That subsidy could come in the form of grant. It could come as Section 106, basically implicit grant, developer subsidy. It could come from charitable subsidy, and that is in effect what housing associations have been doing. They've been making a surplus on other things that they do, and then they've been putting that in to subsidise the kind of core delivery. And in recent years, that public subsidy has made up a fairly small proportion overall of the kind of subsidy going into social housing. So that subsidy, however you are funding the private investment, you always need that subsidy. And I think there's sometimes when this is talked about, there's a kind of sense that maybe private investment can somehow displace or mean you don't need the subsidy. You always need that subsidy to fill the gap. So that's the first point. None of the private investors are offering to kind of charitably subsidise social housing. They want it's about making a return. So then we're talking about how you kind of do the borrowing side of it. As Steve said, so housing associations. I mean, one way of thinking about housing associations is they are a very successful model for harnessing private investment in a not-for-profit governance mechanism to deliver a social good, i.e. social housing. So our members have about £130 billion of debt facilities in place. About 100 billion of that is drawn down. That's about 50-50 bank lending and then capital market lending, so sort of private placements or bond aggregators. There's various aggregators in the sector. So that model is really successful. There is also no shortage of lenders willing to lend to housing associations. If you go out as a housing association to the markets, you can borrow at decent rates. And we can borrow cheaply compared to the rest of the market because we are strongly regulated, have a no loss in default record. So housing associations are very good at borrowing. The constraint, and you said what's the kind of limitation on this model? The limitation at the moment is that for some housing associations, and this is particularly true in London, is their ability to essentially have the cash flow to be able to service the interest on new borrowing. And the reason that is constrained is a number of factors that have kind of come together in a bit of a perfect storm. One is the amount that extra they're having to spend on investing in existing homes at the moment. That's driven by building safety, which you'll be very familiar with, but also kind of broader investment in the quality of social homes, and also the kind of drive to decarbonise social housing. So they're spending more on existing homes. Also, inflation has obviously played a huge part in that recently. They're spending more to service new debt because interest rates have gone up. And then, probably most crucially, housing associations' income, i.e. their rents that they're getting from social rent, is 15% lower, was last year 15% lower in real terms than it was in 2015 because of the impact of various government decisions about rent policy. And the kind of cumulative impact of all that means some housing associations, particularly some of the bigger developing ones historically, aren't able to take on lots of new debt. The constraint isn't the availability of that private finance. If they wanted to take on new debt, it would be there, and I think lots of people are doing that. The constraint is their ability to actually borrow in the first place.
Okay, so servicing that debt rather than getting it.
Rather than getting it, yeah. And so that's why for us the absolutely key change that is needed in order to build more social housing is policy and funding decisions which unlock debt capacity, borrowing capacity, and those are crucially rent policy. I mean, these are central government ones, obviously not for the GLA, but they are rent policy, so CPI +1 rent increases, and crucially also convergence, so rent convergence, kind of technical element of rent policy, but makes a huge difference, particularly in London. The second one is building safety funding and equal access to the building safety fund. Again, a national policy ask, but actually makes a disproportionately significant impact in London. And then third is access to funding for decarbonising existing social homes and improving the quality, which again, a national ask, but actually has a big impact in London because London has disproportionately older, less well-insulated homes across its social housing stock. So all of this would make a very big difference. With those kind of policies in place, and obviously we're looking at the spending review for that, then housing associations would be able to borrow quite a lot more, and that we'd see the kind of recent decline that we've seen in starts that's been driven by this, you would see that reverse and tick up. So that's the sort of, I guess, the context. The question then of leveraging additional investment, as Steve said, there were lots of proposals around. There's lots of ideas floating around. The amortising grant one is an idea that's been going around. There's lots of others, and there are lots of different things. I think some are other debt models. There's there's the model that housing associations traditionally use, which is kind of organisational debt, long-term organisational debt. You can have project debt and other sorts of programme debt and other things. There's joint venture and equity models for development, and the GLA's done some of those in the past, Barking Riverside and things. One subset of all of those models is for-profit providers of social housing, which is what Steve was talking about, which I'm happy to go into, but also conscious I've talked a long time. Yeah,
We'll
great.
come
I'll
back
stop
to
there.
those. Thank you very much. Thank you, all three of you. Assembly Member Lord Bailey, and then Assembly Member Small Edwards, and then,
Thank you, Chair. You've been a great education up to now, you three. Excellent. That's really good start. My first question would be to Steve, though. The models you described, the situation you gave, led me to think of one of the horrors that we face in this sector. That sounds like only large institutions can raise money in that way, have access to that kind of funding. Am I correct in that? How would a small developer get their hands on some of that?
Well, I think the money that's available in pension funds is available to a range of different kind of managers and providers, and whether developers, whether fund managers. So it's not just your Blackstones and your Legal and Generals. There are smaller fund managers that can access that type of pension fund investment. I mean, the for-profit sector is kind of growing, and we'll come back to this as we go through the afternoon, I'm sure. But it's characterised by some big players and some smaller players. I don't think there's a barrier necessarily to raising that type of equity investment, whether it's 500 million or whether it's 50 million. I think there's money available for this type of investment in all different levels and types.
Okay, thank you. And to you, Josh, you talked about Wembley and the model that had happened there, and you talked about a steep rise in the rents. But is that rise above the market rent that would have been there or around about there? The point I'm getting at, we often talk about supply holding down rents, and they certainly supplied some stuff. Shouldn't that? They're not an island. If their rents are sky high, people just go elsewhere. Don't they have to respond to the market around them? Isn't it good that they're supplying something, and then the market will keep the price down, or is that not correct?
Well, that's the theory, yeah.
Okay.
Unfortunately, housing is a slightly unusual commodity that doesn't observe the standard rules of supply and demand. So, I mean, most products, the price reaches a certain level, demand falls. Yeah, so housing does not conform to sort of standard rules of supply and demand for most commodities. So for most commodities, if the price goes too high, demand falls, they have to bring price down in order to maintain market share. With housing, it has two economic functions. It's a consumption good, it's a place to live, bring up your family, etc., but it's also an investment asset. And it's, even within the consumption function, it's a positional good, and it turns out that as people get richer, as their incomes increase, they're prepared to spend more of every additional pound of income they receive on housing vis-a-vis other goods and services. So what that means is you sort of, as house prices go up and even as rents go up, if people's incomes are going up, they're prepared to spend that more money on that, and particularly if they're buying a house, they'll see it as an investment asset. So I think what you've potentially seen in Brent, and there hasn't been detailed research on this, but the hypothesis would be that the build-to-rent developers have come in and they've ramped up the rents. And wealthier people from outside the area have come in and bought those flats and displaced effectively. And some people, there's evidence, well, the data I've got here is that 76% of households move away from the area between 2010 and 2016 during this period of development. So it's this sort of gentrification displacement dynamics.
We'll get into that later, but if they're new flats, they can't have moved away from flats that didn't exist before they are up.
Well, the development in the area raises the value of land, effectively, in the area. So it actually raises the price of...
So you're talking the private rented sector, because the RSLs, it shouldn't raise their rent. The social housing. Okay, I'm just trying to focus in because we have a patchwork in London. And just lately to you, Will, so couldn't this potential problem be managed through contracting? Couldn't it be managed through conditions given when that land is sold, passed over, maybe not sold, but passed over? could an RP be involved so that you couldn't just skyrocket the rents and get your big payout? Is that possible?
So I guess what Josh is talking about is build to rent, which is a market product.
Yeah.
And so I guess rents are set in the market, and you kind of got economics of the market dynamics playing out. Housing associations, almost always only let homes at social rent, maybe something.
I think maybe there's something. Maybe I didn't ask the question correctly. Couldn't RSLs do build to rent? Couldn't we get some kind of hybrid where they did it so it was above the level of the normal rents they provide, and let's say their charitable goings on, but in their fully commercial goings on they could be a little bit less driven by the outcome. Right. Yeah, I see what you mean. So could you have a not-for-profit housing association running build to rent or investing in build to rent? So in theory, yes, and there have been a handful of housing associations who've done, for example, private rented schemes and other things, and usually what is happening there is they're making a kind of return on that, which they're then reinvesting into social housing in that kind of charitable way I talked about a minute ago. I think the kind of realities of the financial economic environment at the moment is that it doesn't make a lot of sense for housing associations to do that because of those capacity challenges I was talking about earlier. The kind of general direction of travel, I mean, it's not 100%, but for most, is actually concentrating back on the kind of core charitable objective, which is social housing for people in housing need. And you've seen some examples publicly of some of the big housing associations kind of divesting of some of these other portfolios they've had in order to just focus on what their core role is. So you could imagine a sort of future where, in a kind of different environment, where that's started to happen. But I think at the moment, given where we are, it's probably not something that's going to be happening anytime soon. Okay. Chair, thank you.
Thank you. Assemblymember Small-Edwards.
Thank you, Chair, and good afternoon, everyone. Thank you for those initial responses, which were massively informative and hugely helpful to our investigation. Just one thing I wanted to follow up from Will. You mentioned, when talking about housing associations, their access to debt, that basically they're a very attractive prospect to potential debt suppliers, and that if they want to take on more debt, they'd be able to quite easily. How can that be the case if you're also saying that they'd struggle to service any additional debt that they took on? I mean, surely the banks or private lenders have, an understanding of their balance sheet.
Yeah, it's good. So if you have the capacity to take on new debt, i.e., you do have the cash flow, etc., to do it, then you are a very attractive proposition because, as I say, it's long-term, stable returns, and crucially, housing associations are very strongly regulated by the regulator for social housing, which means that there's never been a loss. No lender to the sector has ever lost money, which is kind of what lenders look at ultimately. And that's because the regulator, firstly enforces kind of very strong regulation, but also will ultimately step in, or has done to date, will step in to kind of rescue a housing association if needed. So that's why housing associations can borrow cheaply. But the constraint on them doing so at the moment is essentially their own covenants, their own boards saying it's not prudent, it's not meeting our charitable objectives for us to take the risk of borrowing more at the moment. And also the regulator and ratings agencies saying, you don't have the financial headroom within your covenants, etc., to do that.
So essentially, if and when they're in a strong financial position, their ability to access debt is very good, but a lot of them aren't in that position right now.
Yeah, and it's worth saying there's a sector average figure which picture you get from some of the global statistics for our sector, but it hides a very wide range of situations. So you've got some organisations that are really struggling, or not struggling, but are pressured and aren't in a position to be taking on lots of new debt. You've got others who actually have quite a lot of capacity and are busy expanding their portfolio. But I would say the former are more concentrated in London because of some of the issues I've talked about. The ones who are really kind of looking to expand and do a lot more are mostly outside London.
And potentially building like houses rather than towers, which subject to more of these regulations.
That's definitely one of the factors, that kind of makes it easier outside London.
Thank you very much. Thank you, Chair.
Thank you. Assemblymember Garbutt, please.
Thank you, and thanks for your contribution so far. So, Josh, I wanted to come specifically to you to talk about your report. So to quote, the demand of housing as an investment pushes for repressing investment demand for housing with the aim of releasing a portion of the existing stock for either first-time buyers or conversion to social rent. I just wondered if you could tell us a bit more about how that works.
Yeah, so we seem to have developed this very narrow conceptualisation of supply in this country, that it basically only means new build. So we can't increase the supply of housing units unless we build new homes. Actually, we need a much broader conceptualisation of supply. We need to think about the existing stock much more seriously. So just to give you some headline data on London, if you look at the distribution of London's existing housing stock, you have, according to the government's definition of under-occupation and overcrowding, the government definition is if you have 2 or more spare bedrooms, you are under-occupying a home. And if you have less than 1 bedroom per person, you are overcrowded, essentially. So we have 5% of the London bedroom stock is overcrowded, but we have 12% under-occupied, okay, and another 20% as 1 spare bedroom. So if we could find a way of releasing not all of that under-occupied housing, but a portion of it, we could potentially make quite a big dent into that 5% overcrowded figure without the need to build any new homes. I'm not saying we don't need to build any new homes. Of course we do, and actually I think there should be a bit more focus on exactly the type of new homes that we need to encourage downsizing, and probably it's homes suitable for basically older couples who, the baby boomers basically, who are living in big family homes but don't downsize because they just don't have any incentives to do so, because they know they're not going to pay any tax on the massive capital gains that they've made over the last 40 years, so they can just pass that money on to their kids. They're facing a massive stamp duty fee when they buy if they were to buy a new home, and so there's just no incentive structure for them to downsize. Now, if you actually look at transactions in the UK, the transactions of homes, in the 1980s, the housing stock being transacted every year was around 12%. Today, it's around, well, in 2023, it was 4%. So basically, the whole housing market, the transactions process is slowing down. Now, you know, the proportion of only 20% of transactions are new dwellings. So it's a very small proportion of the total potential stock. So this is this is why research we've been doing at UCL has focused on this. We're actually launching a project to think about what we could do with the existing stock. So some of the proposals are, policies that would encourage downsizing, but also policies that would enable local authorities or housing associations to purchase homes at market prices that are sold onto the market, for example, by landlords who don't, for whatever reason, want to continue to be landlords. Maybe they don't want to bring their homes up to the necessary standards required by the government in terms of insulation and quality. Maybe they're buy-to-let landlords who have over-leveraged with interest rates going up. This is a policy that's been used very successfully in a couple of cities around Europe. Barcelona, for example, has got a massive program of, the Barcelona mayor introduced a right of first disposal, right of first purchase rule, so that the local authority has bought thousands of homes, private rented homes, or homes that are being sold on the market, and converted those to social rent, massively increasing the stock. Again, without building any new homes, without needing the planning permission, without needing to find the finance and the debt. So I just think we need to have this slightly broader conception here of what could be done. I appreciate some of the tools, such as tax, are outside the sphere of the mayor, but I think that there could be a case for talking to central government about some of this, and other things that could be done, for example, would be actually giving a tax break to people who downsize on their stamp duty, or there's various sort of carrot and stick options that could be used to increase that better use of the existing stock. I'll leave that there. Thanks.
Thank you. That was going to be my follow-up, actually. Like, what more could the mayor be doing within the current powers of the mayor or lobbying government? But you've made some really good points. We obviously do have part of the Affordable Homes programme that is used for acquisitions, but it's just really good hearing your strong support for that. I just wanted to ask another question. Just, you'll be aware that the mayor went to the MIPIM conference in south of France a couple of weeks ago, where that's all about the focus on kind of overseas investment in housing, and very much that supply framing that you're speaking to and challenging. Because I'm just concerned that if we're not really thinking about who those homes are for and who's buying them, having that broader kind of look at it, then it is quite concerning. So I just wondered if you could speak to just that dynamic of that overseas investment, why we do that, and a bit about that narrative of the supply and how, and the solutions to the crisis. No, just to Josh. Thanks.
Yeah. Well, I suppose my initial comments to some extent address that point around the sort of available evidence we have on the build-to-rent sector, which seems to be the government's kind of preferred approach to this. I mean, I fully agree with Steve that the investing in the return on social housing is not hugely high return, but it is very stable and is very secure, and thus it's very attractive for institutional investors like pension funds or insurance companies that have long-term liabilities that they have to match with assets. I think that the challenge is that we haven't found yet the right kind of intermediary to match those that capital with the sort of social housing need that we have. Rather, we've ended up relying on organisations, asset managers, this sort of asset manager model, the BlackRock model. And what these organisations, as I said at the beginning, are interested in is generating, pretty high returns on investment. It's a fairly, fairly aggressive model when it comes to the built environment anyway. I mean, you also see it in other sectors like water and utilities. I think what I would like to see is a bit more thinking about a publicly owned vehicle of some kind. We used to have the Housing Corporation in London that would manage those investments and work with housing associations and with local authorities, perhaps pool a bit more the combined sort of funds across London, and use them more strategically to support investment in the areas where it's most needed, which would include retrofit and perhaps kind of conversion of some of the existing stock into a more efficient way, as well as just new build. I'm just not sure that we've quite got there yet. There still seems to be an enormous reliance or an assumption that the private sector is the only organisation that has the capacity to do this. Now, I think there probably is a capacity problem, developer sort of lack of developer capacity within local authorities, or public sector development capacity, and maybe it will take a while to address that. But I think we have to sort of accept that there's a problem with the current kind of approach that's being taken.
Thank you. Steve, you wanted to also respond to Councillor Garbutt's question?
Just a couple of points that Josh made. So the point around right of first refusal, I think you mentioned Barcelona. So, we don't necessarily need to reinvent what we've done in the past, and back in the 60s and 70s, boroughs, the GLC, as it was then, were encouraged to buy up empty properties, street properties. And it's one of the reasons why London boroughs still hold lots of street properties as well as estate properties around London. And obviously, they're, at the time, they were very inexpensive, and obviously we're in a completely different market now. But they were unable to do that, and I think that is a clearly part of the solution that people ought to be looking at around better property use in London. On overseas investment, I mean, the Mayor was out there looking for overseas investment, talking with overseas investors. There is plenty of UK-based investment to go at, and I just want to kind of just lay, local authority pension funds have £400 billion. 52 of that is in London and the London Civ across all 32 London Borough pension schemes. The Levelling Up Act was intended to try and bring forward some of that pension fund investment to lift economic growth and housing in each area. That is definitely an equation we need to look at a little bit more closely. There is certainly an opportunity in London to do that. Josh is quite right. The right kind of intermediary. I think we're developing for-profit RPs and the fund managers. So your Blackstones and Octopuses and Man Group, they are wandering into this space. They are part of the solution. But I actually really agree with Josh when he talks about the idea of a publicly funded or a publicly resourced kind of fund that manages the investment on behalf of the pension funds and the ultimate investors. I think that's a really a good opportunity to have a way of thinking about it, because if we can reduce the risk associated with those investments, we'll reduce the price of the money and we'll reduce the return requirements that those investors need. So.
I just think it's really interesting what you said about the pension fund, because we do hear that that's not a mechanism that we can use for housing. So it's just, I mean, I think there's a lot of myths around pension funds. So it's really good hearing you say so clearly that it can be used, because the Mayor last week, when I asked him about the overseas investment, did say that the reason that he was there is because there wasn't enough government funding or investment available. So I just think we need to be really, I think we've heard that really clearly today, that that's a mechanism. I just think that's really important to note.
I will come to you, Will, but I think, so my understanding was that there are lots of pension funds that do invest in different parts of the housing market. One of the things that I guess we are looking at is, can some of that money be used for, as well as kind of for kind of homes for sale and build to rent, but also for social housing, and leveraging some of that in to fill a gap in the public money that's available, rather than the money is not available. I think London Civ doesn't invest as much as it could in London's own housing stock.
Yes.
Yeah. Okay. I'm going to go to Will, and then I will come to you after that. Okay.
It was just a quick point that there is one way in which pension funds do invest in social housing currently is that they are, some of them will hold the bonds that housing associations issue on the capital market. So there is a route there which pension funds are already using to invest in social housing via the debt kind of route, essentially. I guess what the conversation we're having here is, are there other models as yet fairly small or completely untested, which you could also bring more of that in and make it easier for them? And particularly the local government ones, I think there's kind of scope to think about. But yeah, there is that route already for pension fund investment in affordable housing.
Assembly Member Baker.
Thanks, Chair. Thanks. I'm following up on Assemblymember Garbutt's question to Josh around the report around demand for housing and investment. But specifically, last week, I think, yourself and a number of other economists supported a letter from Shelter about investment to a call for the Chancellor to invest in social housing. So in light of that and what the requests that were in that, how would you assess the announcement yesterday of an additional, of the announcement of £2 billion of investment in social affordable? How does that measure up in terms of the asks that you made last week?
Well, I was really pleased to to see that, but my understanding is that's not new money. It's bringing
apologies,
forward.
that slipped in. It's not additional money, no.
It's bringing forward funds that were not going to be released until later in the Parliament, and I think Will probably agree with me that it's not enough. The AHP just needs to be significantly increased, I think. I mean, the other option, I think, is to allow local authorities to borrow more. They can issue, as far as they should be able to issue, AAA bonds in the same way as the central government does. But there are restrictions on the amount that they can borrow. I don't see any reason. I don't really understand why that restriction's in place. Local authorities are building more. Every year they've been building more over the last sort of 7 or 8 years. But they're running into the same problems as housing that Will mentioned about housing associations with these higher interest rates, with new restrictions. So they're running into those problems. I mean, it comes back to my initial point in some ways, that I think there has to be recognition that this is a sort of public good to some extent. The other point to make, I guess, is think about the financing in the round and think about the 30 billion that's being paid out for housing benefit, every year, and think about how by providing more genuinely affordable social rent, we can reduce that 30 billion, and thus, save some of that money that's being spent, and of course, huge amounts of money on temporary housing. This is a huge crisis for local authorities in London as well at the moment. So this is about a sort of slightly, broader conceptualisation of value for money that looks where the costs in the system are being incurred, whether it's people's mental health and ill health, cost to the NHS. Obviously, there's lots of links between the ability to hold on to a job and having decent housing, and it goes on and on. I just feel like probably the Treasury has not got a sort of round thinking about these costs and benefits in the round, unfortunately. So yeah, I do think there are options. Again, it's slightly similar to my previous point. I think that there really is a case for local authorities in London, for example, getting together and trying to create some sort of vehicle that pools the land holdings that they have, perhaps. Because, one of the issues is, particularly over the last few years, we've sort of had actually falls in house prices in London, and in certain areas that's constrained development. But in other areas that you can, if you sell a home in Kensington, Chelsea, you're still getting a big return. So that there is a case if we could pool that sort of land value capture into some sort of vehicle and use it more strategically, I think we could get a bigger return. The problem with the UK, more broadly speaking, a development sector is it's all quite small parcels of land here and there with high transaction costs, and you end up in this sort of speculative development model where developers compete with each other to buy land and are not so, don't have the money actually to put into good quality buildings. So again, it comes back to that point around pooling and some sort of collectively organised public housing corporation, I think.
Thanks, that's really helpful. Well, I know you wanted to come in, but I just wanted to ask a further, because you may want to comment on this as well. Is that okay if I come back to you in a second? Sorry, Josh, I wanted to ask, in terms of sort of the critique of the housing finance model that you've outlined, I think is that fair to say? Do you have anything to say about what the equality implications are of the model as it is?
Of the
how we finance housing as like
the financialisation of the
broader sort of housing finance cycle
overall
concept.
Yeah, absolutely. Yeah. Back to the whole thing.
Okay. Yeah. So maybe I'll just quickly explain that in case not everyone's managed to read the report. The broader argument in the report is that in the UK we have a financialised housing system where we had the sort of liberalisation of the mortgage market, all this money pouring into homes. This pushed up the value, but that actually increased the demand for housing as investment, and it enabled banks to lend even more because they're backing their loans against homes, so the collateral value's gone up. And you had very low interest rates supporting this process. And really, that's the only way you can explain this enormous increase in house prices since the mid-1990s. There's just no convincing evidence that it has much to do with supply. So the inequality implications of this dynamic are, essentially, it helps anyone who happens to be lucky enough to own a house. They get significantly richer. They've gained huge windfall profits over the last 30 years. A 300% increase in nominal house prices since the mid-1990s. If you don't own a home, you're increasingly shut out of the housing market, and you're shut out of those wealth gains. The mortgage market essentially discriminates against first-time buyers because they're unable to compete with people who already own a home, because those people can use their existing home as collateral and outcompete first-time buyers. The efforts to ameliorate that through schemes like Help to Buy haven't worked because essentially they've just involved more money going into the housing market. So house prices have gone up in aggregate. And so whilst it may help some people, first-time buyers at the margin, overall that additional money is just capitalised into land values and house prices. So essentially what government's done, basically what policy's done, is it's subsidised the demand for market housing as opposed to subsidising the supply of affordable housing, and we're providing housing on the basis of what wealthier people want, as opposed to what the population actually needs. So the provision of housing has been delinked from need, is the broader argument. So you have inequalities across tenure, as I've already mentioned, but then another manifestation is across age, where older people who bought homes in the 80s and early 90s have made huge wealth gains. Younger people, most people under the age of 40 in London will never be able to buy a property unless they're earning over 50k. So you have these enormous inequalities across age, and you have enormous inequalities in terms of the consumption of actual space as well, as I've highlighted with this quite spectacular data on under-occupation. So it's a very inefficient and extremely unfair housing market, housing system that we've managed to create. And what we need to address that is much more focus on repressing that investment demand in particular, and subsidising a genuinely affordable supply.
Thank you. Thanks very much. Will, all the way back to what you wanted to comment on, and if you have anything to comment on terms of the inequality impacts, which I'm sure that you'd see, then that would be.
Yeah, absolutely. I mean, I was going to come in on the sort of 2 billion announcement.
Yes, please do.
But maybe a few points into that. One is that so we very strongly welcome that. That is addressing a specific problem, which is to some extent about timing. So the current Affordable Homes Programme ends next. The kind of limit for starting new sites was next March. There's going to be a gap, and we've got our members saying to us and to government, we've got sites we could be getting through the system if we knew there was some funding there. So that 2 billion, which is for 26, 27, is really important because it will allow people to keep going with sites that they've got in progress now. But government have said, and we fully support the fact that there will be hopefully a much bigger announcement at the spending review on what the full next Affordable Homes Programme starting in 26, running for, we would hope, 10 years, but at least 5, will look like. And just going back to what I was saying previously, I think that the spending review is absolutely critical. All these ideas that have been talking about for profits and the various institutional investment vehicles and things, are all worth exploring. But I think it's worth being clear that they are not, silver bullets that are going to negate the need for some of the core stuff that we're asking for from the spending review, and on rents, on safety funding, on quality and warm homes funding, and a big AHP. And that, a sort of package of that at the spending review will mean that we can not only continue building at the current rate, and there's a real risk that social housing supply is going to fall quite dramatically if we don't get some of that, but continue building at the current rate and scale up. And obviously that brings the kind of social benefits that I'm sure we don't need to kind of go through with this committee, but also the economic benefits of social house building and a long-term programme. And we think is the only way that if government wants to meet government's 1.5 million homes target, you're going to need a big increase in social house building because the market alone won't do that.
Just very, very quickly, just to emphasise that all of the policy interventions that Will has mentioned on behalf of housing associations and local authorities around predictability of rent policy, about retrofit grant, an appropriate level of social housing grant from the AHP, all of those things are front and centre of what the investors are looking for and what the pension funds and what the for-profits are looking for as well. So anything predictable and stable around future policy lowers their risk, lowers their return, and increases the potential for their investment.
Thanks. And my next question is actually going back to a subject that we've already covered a little bit because we started talking about build to rent. But I wanted to give, Steve, have you got, did you want to give us your take on what the sector currently looks like in London and what projections you see for growth?
Yeah, I mean, it's an interesting and fairly kind of short-lived tale so far. I mean, we really didn't have build to rent back until about 2014. The growth was quite significant over the following 4 years. I think we're up to nearly 10,000 completions or 10,000 starts by 2018. It's tailed off during COVID and then with the financial crisis and the challenges and inflation and all of the pressures, the financial pressures that have been well rehearsed. And we're down now at around 4,000 starts this year. And there are a number of barriers that are preventing investment coming forward. I mean, the usual quoted ones around building safety, gateway. I think we've got something like 1,200 applications going through the gateway system, and only 6 people in the building safety regulator are assessing them. So there's a real kind of logjam there in terms of assessing those applications. But there's no particular diminution of appetite around build to rent to get back up to that kind of 10,000 delivery. And certainly, you mentioned, Deputy Chair, around overseas investment. Certainly, European investors are very interested in build to rent investment, and particularly in kind of core cities and larger cities like London. But we need to unlock those barriers around building safety. We need to unlock the barriers around planning and around just the delays of getting stuff done. It is part of the solution. It has its challenges in certain parts of London. So there are certain parts of London where it doesn't work as well as others. So to focus on single-family housing, so houses basically on the outer edges of London, not necessarily given to build to rent. But I think what we can say is that it's not going to be a majority sport, and it will continue to kind of tick over that sort of 4,000 to 10,000. And in order for it to get above 10,000, if that was desired, we really would need a sea change in the availability of land and the availability of cheaper finance, and that looks a long way off. So we've just been doing some work with the GLA, which suggests that the current 4,000 starts may, with unlocking planning and building safety, may get to 7,000 a year, and that's probably where we've got the right balance between the level of investment available and the potential for supply.
Just to pick up on something you said, sorry, I don't know exactly what words you used. I think you said there are some areas that aren't suitable for build to rent. Would you just expand on that?
So there are some areas where the returns, where the volume of delivery and the supply and demand and the potential rents that you can gain and the price of the land of investing in those areas don't make it as economic as other areas.
Yeah. So is that sort of linked to what we've heard about basically it not being suitable for people on lower incomes, and they're likely that, the business model might end up having some quite negative impacts for them? The evidence we've heard.
Yes, I mean, I think there are a number of investors that will look to do private rented sector, market rented investments, but maybe not charge a full market rent, but charge an affordable rent with a kind of small a, if you like a discounted market rent or something like that. It's difficult to see how that will become a really large driver of additional supply.
There's not a demand for it, is there? That's not a housing need. Okay. Back to you, Chair.
Okay. Can I just quickly follow up on that? So tell me if this assumption is wrong. The model of build to rent that we have in this country compared to other places like the US and Canada is very different. And it's different in that in some cities in those two countries, there is provision for low to middle income households in build to rent that's not abnormal. Whereas this is my assumption, what is built in the UK and mainly in London is all very nice, but unnecessarily overspec'd and therefore not affordable to those, to a household of maybe three, a family with one or two children, in terms of the kind of amenities that are available in buildings. And I just wonder whether that in itself is the sector holding itself back, whether if they were building basically just flats and houses with none of the swimming pool and all the rest of it, the gym, whether it would be an actual goer in terms of long-term rental housing, which could be held by a pension fund or by a long-term investor over and above what's provided by local government and the GLA.
So I think one of the differences between investing in London and England in particular, as opposed to in overseas jurisdictions, is the presence of the regulated sector, the presence of the housing association and the local authority sector. So if you look in places like, say, Madrid or even Barcelona, you don't have that regulated sector of social housing and affordable housing. So there is an appetite for investment in affordable with a small a, as we would call it, outside of a regulated sector because there's demand and there's potential support from the authorities to do that. In this country, because we have such a large, well-developed, well-managed, well-governed, regulated social housing sector, if you're an investor looking at build-to-rent private sector and looking at affordable housing, you're tending to look in the direction of that regulated sector because you're getting those benefits of the governance and the management and the track record of housing associations and local authorities, and the fact that you have the regulator of social housing, sitting behind that investment. I don't want to be misunderstood. I think there is a role for discounted market sale and discounted market rent. There will always be those investors and developers that will look to make that supply. I just don't know whether it will be, a very large part of solving the housing challenge in London.
Thank you very much. Before I come to you, Assembly Member Lord Bailey, I think Josh wants to come in, and then we'll come to you.
Yeah, just very quickly. My understanding around the 2021 London plan was there was quite big negotiations between the mayor and some big build-to-rent investors, and they basically managed to negotiate exemption from provision of basically any council rent level homes and very few intermediate level homes. And they were quite aggressive in those negotiations. So I think, to follow on from the point Steve's made, I just don't think they're the solution to the problem facing London. And I think given the scarcity of land and given the scarcity of resources, there is a question over whether the current very heavy emphasis on this sector really makes sense.
Thank you.
Thank you. I'm going to come to Josh first. I don't agree with your idea that there's a heavy emphasis on build to rent. Our emphasis in London is definitely on social housing. Yeah, build to rent is relatively new in London, its level of activity. And I just want to come back to something you said, Josh. You talked about if we could... You talked about reducing the money that we spend on subsidy, on rent and stuff like that, on social housing, reducing the housing benefit bill. But what about the maintenance bill? Because you build all these places, because that seems to be what your members are now suffering from, Bill. They've got all these properties and it's come with a massive maintenance bill. So do we shift the bill from housing benefit to maintenance? How do we negate that problem?
So the housing benefit bill, where is that money going? Right, it's basically going into the hands of landlords who don't appear to be using it to improve the quality of the homes that they own. I mean, just to put it sort of crudely. So, and we had this huge transfer of public housing with the right to buy in the 1980s, and many of those landlords were people who benefited from that and are now benefiting, or now getting sort of their income from the government via this housing benefit. So I just don't think it's a system that's working. It's not an efficient system. The maintenance issue is a huge one. Yes, the retrofit problem is also a massive problem, as Will was saying. Again, I'm not convinced that there's a sort of solution to that problem other than more public investment. I just, again, it's not for me. I mean, perhaps there are models that can, profitable models for private sector investment into retrofit. I'm not sure I've sort of seen one, but yeah, very open to suggestions. I'm not quite sure I've understood your question, but
no, I just when we speak about housing, there's this temptation to demonise landlords. There's this temptation to make social housing the answer to everything, and it isn't. For instance, most people in London with a housing need are not eligible for social housing. Is the problem. That's the reason I'm interested slightly in build to rent, is because there's a significant amount of people who it might work for because they can't get social housing, even if we had a lot of it. I accept that social housing is the greatest need because they're the people with the least financial power, as it were. But I'm just concerned about, not concerned, it's just a point, if we're going to reduce the housing benefit bill, which I think would be amazing, because 30 billion a year, in housing benefit will be much better building and whatever, but then it comes with a maintenance bill, which I think caught out many of Will's members. They got a lot of property, they bought a lot of stuff, and then, oh gosh, we've got to look after this stuff. And then people are then trapped in low quality housing with no route out. And I just want to make sure that we focus on that. The other thing to say is, sorry, Will, did you want to come in on that? Or? I could quickly. Absolutely, go for it.
I think quickly just on housing benefit savings. So I guess the argument around housing benefit savings is that if you build a lot more new social housing and then people move from private rent, where their housing benefit is at LHA, to social rent, where their housing benefit will be a lot lower, you are making a saving there. Those new social homes should be built to a decent quality, net zero ready or near to it. And so the kind of maintenance bills for those homes shouldn't be very high, and hopefully we'll have a kind of stable policy environment over the next 20, 30 years where we don't have big shocks. Their rent, well, 2/3 roughly of social housing tenants receive housing benefit to pay their rent, so that is still housing benefit that is going into a landlord, but in that case it's a local authority or a housing association where they're then reinvesting all of that rent into the maintenance of their existing homes, which could be that particular tenant's home, but if it's a new home, it might not need so much of it right now. It might be, someone else in a much older home. There's huge numbers of 1930s and earlier properties across London in social housing that need quite a lot of investment. So that money is going into retrofitting or improving the quality of existing social homes, whereas at the moment you're having a lot of money going into private landlords. So that's more because LHA is higher than social rent, and a proportion of that is then obviously being taken out by private landlords as profit rather than all being reinvested as local authorities or
LHAs.
So
you're effectively saying you can see the saving. You've just explained quite a clear route to the saving of, okay, that's acceptable, because I worry people say things because it's popular to kick landlords and developers and all the rest of that, and I need a clear explanation of where this money's going to go, because it seems to me, this entire conversation seems to me that the government are going to have to stump up some money. I can't hear any conversation here that hasn't looked like the government paying more money, and if we're going to get more out of the government, we have to have a real destination for it. A smaller question now. No, that's not true. A different question now. Is there any key problems to build to rent? Is there any reason that we should just say actually no? or does it serve some value to the plethora of housing problems we have in London? Because, of course, we have every housing problem in London. We don't just have a social housing problem. We have not enough houses for young people, not enough houses for old people. We don't downsize. We can't upsize. So is there a place for Build to Rent? If we were going to lobby the mayor now, should he be doing more to support Build to Rent, and in what particular way? If I start with you, Steve.
I mean, I think, as I said before, there's a role for Build to Rent to provide supply for Londoners that may not necessarily need a long-term home in London, maybe linked to, I don't know, key worker, linked to moving into London for work and maybe staying for 5 or 10 years or 15 or whatever, and then moving away from London. So from that perspective, Build to Rent and the PRS serves the private rented sector serves a function to deliver rented housing for part of the population. But I, as I said before, I think we're reasonably clear, in the company that I work for at Savills, that Build to Rent, a market rented product for people that can afford it in the right parts of London, is very much part of the solution. And it's not a big part of the solution, but it is part of the solution. So I wouldn't necessarily suggest that you just say no, I think was the phrase that you used. Just on the point about the government stumping up money, I mean, I think when you're thinking about delivering social and affordable housing, I just think it's an inevitable conclusion that you have to get to, that the government will need to provide subsidy in one way, shape or form to support the delivery of affordable housing. I mean, it's just one of the financial and economic kind of truisms of the delivery of that type of housing at that price point.
Thank you. Josh, I have another question for you, Josh, because you're much more about the macro of the situation. If we have increasing level, one of the things that worries me, we have increasing levels of people going to social housing. Doesn't that mean we have an increasing level of people when they're older, in particular, that we will then have to cover their rent, for want of a better word, because in social housing, is that a problem? Could that become a problem? Because currently, a lot of people sort of over the age of 50, 60 own their own property, so the state does not pay their rent, as it were. If we put a greater proportion of our population in social housing, will that bill become a problem later on? Where's a crossover point where it becomes a problem?
Well, I mean, so the 10-year trends we've seen in the last kind of 40 years, we've seen falling in the rate of mortgaged homeowners from around 40% in 2000 to 30% now. We've seen an increase in private renters from around 10% in 2000 to 20% today, and we've seen a fall in social renters, excuse me, from well, in the 80s it was around 30% down to sort of 18% now. So I would say that we need more social housing and probably less private rental sector, or we need to sort of shift some of those in the PRS into the social rented sector, because a lot of private renters are really struggling, especially in London right now, where we've seen these huge increases in rents over the last few years, mainly to do with interest rates going up, which has created a lot more competition in the PRS. And you can make exactly the same argument as you're making about the social rented sector, about these people who are basically stuck in the PRS, trapped in the PRS. What are they going to do when they retire? Because they're also not going to have an asset, a home, to sort of leverage against to cover their costs when their income falls. And so to take a big step back, I think part of the problem with the British economy more broadly is that we've moved in the 80s and 90s. We sort of moved. Pensions started being whittled away at and reduced, and people started thinking, I need to buy a house to cover my costs when in later life, and that all contributes to housing becoming an asset, primarily seen as an investment asset rather than a place to live, or conflicts with the housing need, and I think we've got to move away from that somehow, because basically you're not. A lot of people are now shut out of owning a home, even if they're not in social rented, and never will be. They'll still be shut out of owning a home. So we've got to find some, other way of covering people's costs in older age, and that is a massive fiscal challenge. It's a massive macroeconomic challenge, actually, because the population is ageing more broadly, and not one that can be solved, I think, by trying to get more people to own homes. I just don't see that happening.
That's interesting, because
Assembly Member Lord Bailey, I'm afraid we need to move us on.
And for me, you've hit the nail on the head, because that's my worry. I worry that there's a bill we have to pay. It's going to land somewhere, and are we kicking it into the long grass? But when it lands, it could land really quite heavily. And I am really interested about your point that people in the private rented sector are effectively in the same position as well. Thank you. Really appreciate it.
Thank you. Apologies for that. Yes, well, we have a second panel as well to join us very, very soon, and we want to get through everything. But yes, the next question is from Assembly Member Small Edwards.
Thank you, Chair. My question is to Steve. Savills, in a 2021 report, Private Capital and Affordable Housing, predicted that by 2026, for-profit housing associations could commit up to £23 billion for affordable housing, which I believe would be the equivalent of 130,000 new homes. To what extent is this prediction on track, and what does the sector look like more broadly in London?
Thank you. So, back in 2021, we predicted up to 23 billion. I think we're at around 10 to 12 billion across England, and it does tend to be England as opposed to Scotland and Wales because of the particular circumstances of affordable housing and the ability to have for-profit RPs in England. There are 38,000 homes owned by for-profit RPs at March last year. Round about just a majority of those shared ownership and a slight minority of those through affordable and social rent. Around 3,000 to 4,000 rented in London and around 2,000 to 3,000 shared ownership in London, so around 6,000 held by for-profit RPs in London. Has it gone on the track that we predicted or projected? No. I think there's a couple of reasons for that that are particularly have driven that. It's not exactly a slowdown, it's just not a speed up as quickly as we projected. The first of those is around financing and costs and the cost of debt and the cost of finance. That's obviously acted as a drag on the investment coming forward. And secondly, the knock-on effect of a reduction in development, private development, and therefore a knock-on effect of a reduction in Section 106 and the availability of Section 106 affordable properties within London to be bought up by for-profit RPs. So, are we still on a trajectory upwards? Yes. What kind of conditions would we need to see in order to kind of accelerate that investment? The sorts of things we've talked about, those policy initiatives that Will mentioned around rents and predictability of policy, dealing with the building safety challenges, particularly for tall buildings, a recovery in the development market more widely, so drive the provision of more Section 106, and a reduction in financing costs. We're often asked whether for-profits really work in London compared to the rest of the country, and I do think that some of the challenges that we've seen around investment in tall buildings and building safety do suggest that the investment of for-profits in London is at a lower proportion than the rest of the country. But for-profits are investing in London, and they're continuing to do so. And we are involved with establishing new for-profit RPs for developers and for investors and for funds, and they are based in London, and their first schemes are based in London. In fact, one of the responses of some of the key developers in London is in not being able to get their schemes started and sell their Section 106 to Will's Housing Association members because of the pressures we've heard over there. Their response to that, in order to keep the development going, is to set up their own for-profit RP. So it's, as I say, I don't think we're saying this will ever be the majority provision, or certainly not in the foreseeable future, the majority provision, but it certainly is part of the solution, and it's certainly on the way up.
Thank you. And I guess a very different interest rate environment when that report was written in 2021. Thank you very much.
Well, a different interest rate environment and a different gilt rate environment as well. And we are at a recent historical high on gilt rates, and a lot of these investors will price their investment based on gilts as well as interest rates. So we are at a historic high, and they've suffered quite significantly since the turn of the year, I think, has been widely reported.
Back to you, Chair.
Thank you. Assembly Member Lord Bailey.
Thank you, Chair. I'm going to come to Will on this. How do your for-profit housing associations and traditional housing associations work together, and what are the challenges and the opportunities?
Thanks. So I think the first thing to say is, so we, National Housing Federation, only represent not-for-profit housing associations. So for-profit registered providers can't call themselves a housing association, and we've sort of worked to kind of protect that phrase housing association. It's in law and it means not-for-profit is part of its kind of definition. So we represent not-for-profit housing associations. The for-profit RPs are a kind of separate entity, and it's worth kind of reflecting on that. The key difference is housing associations are charities, for-profits are, it's in the name, profit-making institutions. But our members do work, some of our members do work quite closely with some of the for-profits, which kind of Steve outlined. So I think there's 4 ways they do that. One way is manage homes for them. So some of the for-profit RPs will contract a housing association to provide the housing management, kind of day-to-day service. Second one is they develop homes together sometimes. So the for-profit might fund the development. The housing association will do the development because we've got development teams, and then the for-profit will own it. Sometimes they combine, so you build it and then manage it. There have been some examples of housing associations selling small portfolios of existing homes to for-profits. I think that's almost all been shared ownership homes. And then there are literally one or two examples of housing associations setting up kind of a for-profit within their own group structure, which is something, kind of an idea that I would say hasn't got going yet, but is something that a couple are exploring. So there's a few different ways. And I think for our members, individual organisations entering into those partnerships, their focus is this good for our tenants and our residents? Are they going to get a good service? Are their long-term interests protected? Is this protecting our social housing assets or those in future? And there's a lot of focus from our members on, the individual partner that they're dealing with and due diligence on that partner, and are they do our values align and that sort of thing, which is absolutely right. At the level of an individual organisation, that's what they should be focusing on. I think the question, where it would be really interesting to do more work, and something that we'd like to be a part of, but it's one for lots of others as well, is what does the long-term evolution of this model look like, and what are the pros and cons and the risks and opportunities longer term? Because you're essentially changing the kind of political economy of social housing. So you've had local authority-owned social housing, the rise of housing associations, which a shift into a kind of not-for-profit governance model. This is a shift again into a for-profit governance model. And there are lots of things that you could analyse in that, which I think so far there hasn't been much of a public debate about that. And as Steve said, within the for-profit structure, there are actually lots of different types of organisation trying different strategies. There's some that are investing very long term, there's some that are quite short term, there's some that have worked, there's quite a few that haven't, so there's quite a lot of registered for-profits that haven't managed to get anywhere yet. I think it's a very kind of under-analysed area.
Can I just chip in there? But if the thing that makes a housing association unique is that it's not for profit. You're not the same. Isn't someone who's for profit just a developer then, really?
I guess they're a long-term asset owner, rather. So the developer model is you build the homes and then sell them.
Well, some hang around a little, do they?
Sometimes, yeah. Yes. I mean, a build-to-rent, an institutional investor in a build-to-rent property would be a long-term asset owner. A for-profit RP is just a more regulated
right.
entity.
So that's okay. That's the bit I'm trying to get. What's the difference? Why would we potentially transition from one for another? Because for all of their vagaries, we are quite happy with the housing association situation. Everybody seems to, there's tweaks we could make, but it's something we like. Why would we transition away? The question it leads me to then, in this current climate, that you as well, Steve, in this current climate, would it be easier for a for-profit association to develop, to build houses in this current climate?
Well, I guess the challenges around viability, interest rates, etc., are all the same.
Right.
Yeah. Some housing associations that are struggling for the capacity to borrow additional funds, that is their constraint. As I say, the kind of policy changes we talked about would unlock that. So that would, for profits, don't have that constraint because they largely don't own any existing homes that they're having to invest in, or tall buildings in London that they're having to remediate, or any of that sort of thing. So that is a difference. But as Steve said, it's fairly untested still. I mean, it's 38,000 homes across the country compared to 2.6 million in housing associations and similar in local authorities. So it's a very different scale of model. And I think that, it is still unclear sort of how it evolves, particularly in the kind of medium and long term if it took hold.
Okay.
I mean, just on the point about it's 38,000 out of 4 million social homes, that's absolutely right. It is. We are at the foothills of this. But a different way of looking at the statistics might be that in 23-24, for-profits were accounted for around 1/5 of the acquisition of Section 106 properties. So, in terms of the sort of the marginal kind of increase, I think has been quite significant. And as Will says, whether that will continue. Will for-profits be in a stronger position? So yes, because they haven't got the existing problems with the existing stock and the challenges around their asset management. Yes, because they can effectively build a service from scratch, and it's all provided to brand new properties with brand new tenants. There are challenges with interest rates, which is the driver for financing housing associations. But as we've said, there's challenges with gilt rates, which are the driver for financing of for-profits and investors. So, whilst it's easier from the perspective of we're starting with a relatively clean slate, the financial challenges, I think, are equal between for-profits and for not-for-profits. Well, not equal, but they are, similar, but from different directions. Just wanted to come back on what Will said just very briefly around we used to publicly fund social housing through councils. We have had a mixed funding model over the last 40 years with housing associations. There is nothing to say that the next cab on the rank, if you like, equity investors and for-profits, is something that will replace that delivery. It's joining the sector and it's helping to provide that kind of mixed economy of delivery in future. So I don't think we're looking at it kind of replacing. I just want to kind of place that on record, really, because that I think it's often talked about. Well, housing association got this avenue, and we've got to look in the direction of pension funds to solve the crisis. They're part of the solution, but not the solution.
Thank you for that. Chair, I wonder, as a committee, we might want to look at for-profit housing associations in our next term.
That we can take that to
I just put on record that it's something we should have a look at. Potentially.
Yeah. Okay. That's between you. I'll say. Thank you very much. I do have a question about land values, but in the interest of time, I know you've got to leave, apologies. I will ask Diane or Sarah Jane to send that to you, just some comments you made, which were very interesting. So I'd like to thank you all today, and we're going to take a 5-10 minute break, and then we'll come back to the second panel. Welcome back to today's Housing Committee meeting where we're discussing financing in London. And can I please welcome our second panel of guests, Piali Dasgupta, who's Strategy Director at London's Future and Places for London Councils, Beck Seeley, who's the founder of Places Partners UK, and joining us online is Angela Wood, Deputy Executive Director of Development at Peabody. So let's go straight into the questions. And I don't know if you heard some of our discussion earlier, but if not, then we're here really just to kind of learn from you about how we might kind of look at the financing of housing supply in London, both in the social sector and in the for-profit sector, with obviously the kind of umbrella of the national targets that are being set for delivery, and specifically here in London, and in particular the need for affordable housing. So we've been quite free-ranging in our questions and responses, so I'll kick off with the first one to all of you around partnerships. We'll start with Beck, and then Piali, and then we'll come to you, Angela. So how do the organisations you represent partner with public and private institutions to deliver more housing? What are the challenges and opportunities of these partnerships? So Beck, if you'd like to start.
Hi, thank you very much for having us. I work for Place Partners, but we've been working probably for about 18 months now supporting Opportunity London with its engagement with both private sector institutional investors and boroughs around how we bring forwards more affordable housing particularly, and also working quite closely with some of the GLA teams as well on that. And obviously, Opportunity London is sort of co-sponsored, led by London Councils, and I'll hand to Piali for that piece in a minute. So in terms of the sort of public-private partnerships and the opportunity for us to do more, some of the challenges in that, I think what we are seeing from sort of both sides of engagement in Opportunity London is a real challenge over everyone wants to do more. I think everyone is talking and well engaged and really trying to do more, but there are some fundamental issues around particularly viability of schemes where effectively public sector is massively trying to push delivery, trying to get things going, but fundamentally the private sector can kind of want to do it all it can, but the numbers just don't add up in terms of where the returns are for that private capital. And in order to bridge that gap, you're talking about effectively potentially very large sums of public sector grant type funding going in, or there's just simply not enough, it doesn't make sense, and then kind of things just can't progress forwards. So I would say the thing that is sort of the biggest issue everywhere is that word viability. In terms of things that are contributing to that point, which I'm sure you've heard from many people, so if I just give you a couple of things in terms of where capital is right now, and institutional capital. Institutional capital, so big pension funds, those sort of organisations, I think are really keen to try to help, particularly on affordable housing and making things happen. The reality of it is they have a return that is more than, say, a traditional RP return would have been. And that return is more for a whole range of reasons, because it needs to be more to pay out pensions, but also because traditional RP capital would have had a fair old degree of public sector subsidy inside it, so therefore it was cheaper. So I think those sorts of organisations are very willing to come to the table, can access some funding, quite weighty funding, but because the rate of return that they require is higher than an RP would have required, you put it into a set of numbers in a scheme, and obviously it doesn't work versus that traditional RP type position to fund some affordable housing. The other things probably I would just draw attention on viability that I'm sure you've heard before, so I won't go too much detail, but build costs, very extensive increases over the last few years, driven by both inflation, so cost of materials, cost of labour, etc., but also changes in regulations, enhancements, updated regulations, lots of things in there driving additional costs. And also, I think, probably where we are right now is possibly a real challenge on confidence around the ability to get things built, particularly new tall building regulator, ability of people to get through that in a time period that works for them, ability to get through it at all, actually, because it's still got teething problems. And that basically goes straight to, if I'm a private partner and I'm trying to help and build things and work with the public sector, can I buy a building contract that's going to be done on time at a price, and does actually that come home and work? So there's a whole range of things in that area. And probably the final point I'd make just on the viability is that there's a real challenge in terms of how, if a consent has been given in the past, so it's quite, a several-year-old consent, what were the assumptions in that consent over the amount of affordable housing that could be provided? And are they actually assumptions that really work in the world we're in at the moment? And that's something we're also finding, is that there's an awful lot of willingness. I don't think anyone can be unwilling to try to solve housing and affordable problems, but actually we've just got this time period issue where something was kind of worked through, set of numbers, viability, etc., several years ago in a different world. We're now in this world, and it's just kind of stuck. And that's what we see a lot of from all of our stakeholders. So just giving you a flavour there.
Thank you very much. Piali, would you like to go next?
Thank you very much, and really appreciate you inviting London Council to speak. And just thinking about the spring statement today, it's kind of really, again, a cautionary tale for all of us, isn't it, in some ways? So I represent the 32 London boroughs and the City of London. I don't deliver schemes myself, so some of my expertise might be a bit limited, and I'm sure that Angela and Beck will be actually much more insightful about what it actually takes to get schemes over the line and land investment. But I can perhaps speak to some of the challenges that boroughs are facing when it comes to partnering and playing their own role in development. If we just cast our minds back in 2012, councils hadn't been building for decades, and so they've come back in a big way, almost overnight, which I think we should be really proud of. But that's meant that they've had a long history of learning to partner, because actually their role for a very, very long time was more about market shaping and trying to engage private developers in doing business. So we've had to take some of that knowledge into actually, once we're back into the building business ourselves, how do we start to partner in different ways? So some of the functions that might drive partnerships for boroughs will be, either you just need a development partner because you don't have the expertise for the complexity of the scheme that you're trying to do, or you just don't, that's not what you've invested your own council staffing into. You might need some support from the private sector around management of the homes, or you might need some financing support. So some of those are the sorts of decisions that will be driving your choices about how you might partner with other partners, be it registered providers or private sector. I want to draw attention to two of the models specifically around affordable housing, because I don't want to duplicate what Beck has said too much and presume, anticipate what Angela might say. But the two models in particular around partnership that have been helping to drive affordable housing supply in London are broken. And one of them is obviously Section 106. You might have heard a bit about that, but basically we've been negotiating through Section 106 agreement affordable housing provision, but those developers right now can't find anyone to buy it and manage it. So that has been actually pretty important for not just London, but also for the wider southeast, a pretty important model, just not quite working. And that's partly because registered providers, and Angela, I don't want to steal your thunder, but our money is going into repairs and maintenance, damp and mold. It's not going into what it used to. And the other bit is around cross-subsidy of the model where, and this is where we partner sometimes, be it through JVs or other types of structures, to basically sell market homes and then use the profit to cross-subsidize social housing. And again, that's become more and more difficult because we just can't make that model stack up anymore. So I think it is exciting to explore what private capital can bring to the mix right now, but we haven't yet found a reliable model as boroughs that give us the assurance that we can bear that risk for the long term, because there's a lot that's not in our control. So with the flick of a switch, the government can make a decision about local housing allowance that undermines our revenue. They can do that with social rent policy as well. So there's not enough in our control for us to feel assured about it being able to buy into those longer term models. And the one other thing I just wanted to put on the table before I cede the floor to Angela is just, we're also really worried about our own housing revenue accounts right now. we think that just repairs, maintenance, damp and mold demands alone probably amount to about 25 billion. And with all the new regulation in that sphere, we can't afford to disinvest. And to be honest, we care about our residents' safety and their health as well. We don't want to disinvest in that. But that has severely squeezed the money for new development. One thing I want to put on the table that we think is worth considering for government is that when we kind of bought ourselves out of the old debt financing arrangement with government, we agreed a debt settlement with government that was predicated on assumptions that the government hasn't held to. So it was predicated on rent keeping pace with inflation, things like that. Those assumptions haven't actually held for most of the last 7 years. If we revisited the debt settlement on the basis of the conditions that were actually put in place for London boroughs, we could probably get back 2 to 3 billion that we could reinvest in housing. Not arguing that Treasury is open to that, but in terms of fairness, that would be something we'd want to put on the table.
Before I come to you, Angela, and I would appreciate it if you could reflect on this as well. So to you, Piali. So what you're basically saying is that the two historical ways of delivering social and affordable housing, Section 106 and cross-subsidy, are broken. We understand that. Looking at financing from alternative sources is an area which is a possibility, but councils are understandably quite cautious. And with that in mind, how do you where else do we find the money? We've been sat in here all afternoon, so we can guess what Rachel Rees said, but we haven't heard it ourselves. Yeah, and that point around the debt settlement, so kind of there are monies to be recouped from within the existing system, but where are London councils going to get money to build affordable housing, in your view?
I don't have an easy answer for that, but I do think one thing on the other side of the equation that could help is cheaper land. So how do we find cheaper land to build with, which can also make the numbers add up differently? One of the sources of that, we think, is to be able to use the public estate differently in London. So, for an example, the NHS estate right now, when you dispose of an NHS asset, Treasury takes that money back into central coffers. If we could either use that land differently to build housing or use the receipts from the disposal to put into housing, that can make a massive difference in terms of the viability of some of the social and affordable housing. Police estates similarly, perhaps even some defence property. So that's the area that we'd love to explore, is how do we get cheaper land into the equation when there's no easy source of money.
Thank you. And to you, Angela.
I just want to a couple of points made there, if I may. Our issue isn't so much buying new land and hence the need for cheaper land. At Peabody, we've currently got about 6,000 homes currently being built. But we've also got a pipeline of around 5,000 homes that we could be building. So we own the land, we've got planning permission, albeit some of those might need to be revised because the second staircase, but they have viability issues. So we have the pipeline, but we can't deliver it for many reasons, also including the capacity issues, which I guess in the first panel session, you discussed that and the reasons behind that. So we're in a slightly different position. And I do recognise some of the comments that Beck's made as to why it's difficult to attract investment, private investment at the moment. And I would say that I think the one thing that Beck didn't mention is about rent certainty for affordable housing. And you'll be very familiar with the impact of rent settlement and what's happened over the last 10 years with our rents reducing, our rents being capped, and the billions of pounds that's wiped off of our own balance sheets. But that uncertainty also impacts anyone who's considering partnering with an affordable housing provider. But in terms of the question around how we currently work with the public and private institutions to deliver more housing, we do traditional joint ventures with house builders and developers who've got their own contracting arms, and many RPs are well versed in that model. We've got 13 joint ventures that are currently live, But there really is continued demand from that sector to carry on doing that. And particularly investment partnerships is something that people who operate in a partnership model are very keen on. And that's where taking a more strategic and longer term approach. That doesn't work for Peabody because we can't look for new opportunities. Our problem is trying to solve how we deliver the opportunities that we've currently got. And the other way that we work with the public is obviously with people like the GLA, for us in particular in London. And we've benefited historically from bespoke grant agreements. For example, our Ford stamping plant site in Dagenham. And historically, we've had loan finance from the GLA for our Holloway Prison site in Islington. So we have got some examples of how we're working in partnership with the public sector. And that's something that we're very keen to do more of and to explore further. So that's kind of some of the opportunities there. I mean, some of the challenges around that, I'm just trying to think of anything else that Bex hasn't covered. You've talked about the return expectations and not quite matching and the viability issues. You know, that's certainly what's holding up us delivering the rest of our programme, along with the capacity. So there's obviously some opportunities to correct some of those things, but kind of that's my starting point, really.
Thank you very much for that, Angela. Before I hand over to Assemblymember Small-Edwards, I just wanted to put a question to you that we ran out of time to put to the previous panel, but given you're from an RP, this is probably more relevant to you. So we heard in the previous panel about rent convergence, and part of that being the settlement that was promised and has not been stuck to. I think obviously, as an RP, a developing RP, you're trying to balance existing tenants with new build. And I just wondered if you have any reflections on whether or not rent convergence is the cause of issues for existing tenants, because obviously they're part of the mix that a private developer won't necessarily have to consider if they're building and then leaving once they hand over.
Do you mean if that's part of the problem with us not having invested as much in our stock as we could have done?
Yes.
Yeah, I think that's definitely had an impact. And I mean, if you talk about the billions of pounds that have been taken out of the sector, I think G15 are kind of saying that, you know, we've got the ability to create an extra 3.5 billion to come back into the sector through a rent settlement and through rent convergence. So, you know, there's some significant money, but yeah, I'm trying to think of the numbers of how much money that we've lost through that, and I haven't got that to hand. So actually, yeah, so we've lost £211 million in rental income since 2015. And for G15, obviously we're different size organisations, but that's between 5.3 million and 52.9 million a year in rent loss. So that's a significant amount of income that's impacted how we operate our businesses.
Thank you very much. Thank you, Angela. Assemblymember Small-Edwards.
Thank you, Chair, and good afternoon, everyone. My question is also to Angela. And Peabody recently announced a partnership with Hill Group and Goodstone Living on a build-to-rent scheme on Dagenham Green. What makes build-to-rent an attractive prospect for housing associations like yourself, and what are the challenges with the model?
The build-to-rent scheme is a way of forward funding a project. So we achieve a sale early in a development programme. And those deals help to keep our cash flow requirements and large developments much lighter. So and that means we're able to do more with those resources. But also at a scheme level, it can significantly de-risk the market sale that we need to deliver. Particularly for a scheme like Dagenham, which is a multi-phase project, you know, it enables us to deliver more at pace, and we're less reliant on sales absorption rates. And that just means we can build more quickly, and in the case of those large schemes, can generate placemaking more quickly. So that's really important to us. Also, pre-sales help unlock cheaper debt financing. So that's important when we're operating with a joint venture partner where we've got an off-balance sheet arrangement. And we also see market rent as being really complementary to a mixed tenure neighbourhood, and particularly on those larger phase schemes where we kind of give a really broad possible choice of different tenures. And on that particular scheme, we are delivering 50% affordable housing, but obviously it offers another range of tenure. For this particular project, that was always our strategy. So, you know, that's kind of, I think I hopefully explained the benefits of that for us. In terms of the challenges, I think we considered ourselves really lucky to get the deal with Goodstone over the line. It took a long time to do it, and you know we were very glad that the deal held and we were able to get it over the line in the time that it took us to do that. And we understand that the market in London has particularly tightened for build to rent. You know, there's underlying viability challenges, there's rising cost of debt, which does give us a slight cooling in the market rental growth. There are some risks to these kind of deals, because what we do is for the benefit of having a pre-sale and all of those good things, you know, helping our cash flow, de-risking sales, it does mean that we take build cost risk. So in the past, Peabody has another build to rent project, and we locked into that at a point with a JV partner. We then subsequently saw, you know, the extraordinary inflation that we've all seen in recent years. So, you know, we just had to deal with that and to manage that, and that scheme's sort of coming forward to completion over the next few months. But it is a risk, and so you have to kind of balance that off with the opportunity. We found that there can be inflexible requirements from the partners' funders. And particularly for housing associations, they would like guarantees and indemnities, which we often find difficult to give because we're obviously a charitable organisation. So we've had to kind of work our way through that. And I would just say as well, in the actual sort of construction and the design, shared infrastructure can be quite challenging. We've got buildings that are linked by podiums, we've got linked fire safety strategies, linked life safety strategies, sprinkler tanks, etc. That can make, you know, management difficult to deal with service charges, etc. So from an operational perspective, you have to think about it very early. And investors and their funders are quite keen to have a red line around their assets. So it sounds quite simple, but the reality can be quite challenging. So it's something you have to kind of give a lot of thought to early on, particularly if your strategy is going to be incorporating that kind of tenure.
Thank you very much, Angela, for that very comprehensive and informative response. I appreciate on the Dagenham scheme you said about it being 50% affordable, which is obviously music to our ears, I think, on this committee. More broadly, though, with build to rent, I think it was suggested in the previous committee that it could be at the expense of additional affordable housing, and that would probably be my fear around build to rent. Do you think that is the case? And given, particularly in inner London, central London, there's limited land available for housing, is build to rent the best use of that land?
I mean, I guess it depends who's taking forward a planning application. So in our case, we've taken forward a planning application and we've had a strategy that part of the homes that were to be delivered for market sale would be delivered as build to rent. So there's no loss to affordable housing in doing that. I'm not, I work for a housing association, not a build to rent organisation, but there are those that buy land and take forward their own planning applications. I guess it's for local authorities to kind of work within the planning remit as to what affordable housing is due to be delivered, and fight to keep that in, really.
Thank you very much. Moving on to Piali and Beck. Opportunity London seeks to attract investment into housing in London. What progress do you think it's made so far? And how confident are you that the recently launched investment prospectus will meet its £22 billion goal?
Before you answer, sorry, would you mind please just explaining very briefly what Opportunity London is?
So in terms of what Opportunity London is, it's sort of like the front door, I think, for investment into London. So the aim is to bring together both the public and the private sector kind of groupings in London, and that really we go out to investors with a really clear position on what we have to offer as London. And then the investors, they can kind of come in, and Opportunity London can not only put forward specific projects, but also it can help guide them through kind of, the different areas and systems within London. I think there is a particular focus on international investment in there, which obviously is key really to kind of the quantum of investment that, we would hope as London to attract. And also, I think an important part is, having spent quite a few years myself working for both UK investment and international investment often has a risk profile that's different. And so it can help projects that maybe domestic investment actually just can't get their head around. And international investment also brings different skills. So what you find in some of those investors is they've got they'll come and they'll set up teams, but they'll also bring teams, and they'll bring a different perspective, and they'll move the market and the product on. I mean, actually, the earlier conversation about BTR is really interesting because a lot of US investors and people who bought off over US experience in BTR many years ago established that, and it kind of works through London kind of market as well. In terms of where we are and what we've been doing, so I probably would break the activity down into sort of like a couple of buckets. And I kind of do feel like I'm speaking for Jace Till, who's the CEO. He should really be doing this little bit, but I'll try my best. So firstly, I think there's actually getting projects from London into a position where they are in like a digestible format for an investor to understand them and consider investing. And this is something that I think, Piali might have something to say on this as well in a minute, in respect of it isn't sometimes naturally the position of, say, a local authority that they have the skills and the experience to be able to take what might be a really good project and put it into a form where an investor can understand that. So sometimes that's about, getting the pitch right. So what's the story? What's it doing? Quite often it's probably about, you've done 10 pages of pictures but no numbers. An investor wants numbers and they want them quite quickly. So there's a bit of, what we've called sort of working through a prospectus, and that has been launched, I think it's on its several iterations now. But what that does is not only does it bring you a kind of, comprehensive show of various London projects, but I think actually it's the work in the background that really starts to kind of move us forwards as a city in working with local authorities, working with private partners, and bringing, those projects to a shape where an investor goes, okay, I can kind of see what you're asking for now and I can properly consider it, versus I don't even know what you want, right? I'm just not clear, in which case I'll just move on. So that's the first part. And then I think the second part I'd say is really around a huge amount of direct investor engagement. And Jace has spent, an awful long time flying around the world, engaging directly with, investors in their home environments, listening being the key skill to understand, so what do you want? And what will make you invest and come and support London projects? And that brings back this huge wealth of information that is then shared through all the kind of networks that Opportunity London is a fundamental part of around, for example, this is what Japanese investors are looking at the moment. This is the kind of risk profile they'll take. This is what they won't take. This is, this is where American investors are. Actually, they're not going to touch that. So don't waste your time. Think about it like this. And I think that is if you put those two parts together, then you suddenly start to get, and I think this is where Opportunity London, it's not about claiming credit. It's about facilitating and pushing. Then you start to get things that actually, if they can be unlocked with investment, then you've moved them forward. So actually, you've got success in terms of investor, local authority, private partner, whatever it is, making it happen.
Thanks, Beck. I think you put it really well. So just a couple of things to add from the borough perspective, but they're bringing to the mix. I think the first iteration of that investment prospectus was, if I'm honest, a little bit of wishful thinking on a part of a lot of boroughs. Boroughs, schemes out of part planning permission, financing not secured. I don't think we would have really considered it a proper investment prospectus. And they've really helped. The third iteration that we've just produced is much sharper. And part of what Opportunity London does is it gives us access to partners like JLL and Arup, who bring that market intelligence to kind of basically raise our game, if I'm really honest. But they also do a lot of that behind the scenes. We do quarterly borough workshops where we really sit down and look at. Recently, we did with Camley Street in Camden and tried to not just understand the design of the scheme, but actually how was the borough smart in their relationships when they went out to market? How did they act as an intelligent client in that space to make sure that residents' views were heard in it, so that you're not kind of, I guess, sometimes wowed by market players who sometimes have more money, more lawyers, more whatever than we do. We don't always have the commercial skills that we need to. So it's helping us collectively raise our game with some of that. What it's also helping us do is understand a bit more about where we might, while the global market is not so favourable about residential development in London, where could we be putting our eggs to keep things moving in London? So energy's really shot up the global agenda right now, and we're doing a lot with the GLA on local energy planning, area energy planning. There's a lot of scope within our whole pipeline across London to start unlocking a lot more capital for energy, which, though not direct kind of generating housing development, is pretty pivotal over the next 10 years of pipeline development. So part of what we're holding right now is, what do you do right now to keep house building going? But what are we going to do over the next 10 years to keep hitting that target over and over and over again? So I guess just to not kind of cover ground that Beck did, but they're really helping us raise our game as boroughs. They're also encouraging us to have conversations that take us out of our comfort zone, if I'm really honest, around planning friction, the way that we're sometimes giving mixed messages as boroughs to developers. Those are private conversations that I can't entirely share with you, but believe me, I've worked with councils for a very long time. I've not seen our politicians have these levels of uncomfortable conversations with each other in a way that I think is really important to the outcome, but hasn't always happened. And I think Opportunity London has given us a safe, kind of an honest broker to have that discussion.
Assembly Member Lord Bailey.
Thank you. I'll go to Bex and I'll come to you. In our first session, there was talk of, so we're currently now talking about international investment, but in our first session, there's a lot of talk about just the huge amounts of money we have in Britain, here in London in particular, that is not directed at our housing. And then we went on to talk about how we could set up some kind of government-backed scheme. How realistic is that, a suggestion to you? And how far away from that are we?
So if I just come back to the point on viability, then if we just think about how do you find money in the private sector first for housing, if you go into like real estate finance pool, so you're now looking for things that fund managers will classify as a real estate investment, you're looking at a level of return that reflects a real estate risk. And that is, as I said in my intro, for affordable housing from an institution, it would be more than a traditional RP would have been, because the RP would have been government-backed in the way the finance is coming from. So if we can move into government-backed financing, so be it a guarantee, however that's structured, then two things, basically you move from being an element of risk into less risk equals cheaper money, can do more, helps unlock viability numbers work more easily. I think the really important point that gets lost, though, is you move into a different pool of capital. So when you're fishing in this real estate pool, you've got an allocation in a fund that says I can put so much in real estate, so much in bonds. So you're kind of capped really at the ability of, and the appetite of that fund to want to do real estate, which is actually an issue at the moment. But if you move into government-backed body, call it what you want, funds, etc., if that's structured right, then that kind of becomes a bit like a bond type investment, and it's no longer a real estate investment. That means potentially much more access to funding, so more money available, also cheaper. So I think, could that help? Then yes, it would make things cheaper, and it would make different pools of capital that are potentially here be able to put more into housing because it's classified as something different. Can it happen? So we've had kind of lots of discussions with like all ranges of levels of government through the Opportunity London thing, because it's so often the first thing an international investor says, because in other countries, like that is kind of, they would see that as just a standard position. That's probably the wrong word, but I think you know what I mean. It's just that they just walk up and they expect that. I think the challenges we have here are that, and there's a whole range of them, and I'm not a good enough finance person to know the detail of it, but essentially that is what is classified on the government balance sheet as debt and how that works if guarantees are given and the capacity of that. But definitely, would it work? Could it help massively? Can it happen? My feeling is that there's probably some decisions and policy, I don't know what, around this, how people feel and classify things like guarantees underneath it.
Okay, thank you. Do you want to add, or is that? Oh, absolutely, thank you, I appreciate that.
So I guess not so much on the financing, but the importance of the build-to-rent sector, why it could make a difference in all of this, and the interconnectedness of some of this, is that one of the factors driving our temporary accommodation crisis in London, where boroughs are spending £4 million a day right now, is because the private rented sector supply has dropped so precipitously, right? So we're 41% down from pre-COVID levels. Rental supply in London is pretty critical to a lot of sectors, but also to TA. And what that would in turn do for us is the money that we're now putting into TA, we could actually turn that into debt servicing and actually, lift our borrowing headroom. So these things are interconnected, even though they don't always seem that way.
Okay, thank you. Back to you, Chair.
Yeah, I'm going to come to you. I just want to do one quick follow-up, which is where I've got thousands of post-it notes. So does all of that hold true if you're wanting to build social housing? I'm just conscious that we've talked a lot about international investors and the prospectus and it trying to bring in 22 billion. In our experience, correct me if I'm wrong, one of the things that happens is that if you're kind of very focused on private finance, one of the ways to reduce costs to the developer is to remove the social aspect, the 106, or the social aspect of that of that development. How is that protected? How are you making sure that the fund is also developing an appropriate level of social and affordable housing, given that the Mayor has got targets around what that should be? Hand over to you straight away, Councillor Gutt. Assembly Member.
I want to be able to say that there's lots of other options apart from government grant, but that is pretty pivotal to social housing in particular. Our grant levels in London haven't kept pace with viability in a long time, and boroughs have been trying to close that viability gap through their own borrowing and sometimes put their own land in. We're running out of road on that one, and I don't like to say this because I actually really like to be able to find things that aren't always about public spending. Unfortunately, on social in London, I don't really see a way around government grant.
So I was just going to add on the point around the social housing that actually I think the feedback from private developers and investors is that they do really welcome a reasonable level of affordable and consents. And it relates to the point Angela made earlier around being able to move through and develop quicker. So if you are entirely reliant on private sales, there's a sales rate that you can achieve, and that is not particularly fast, and that means that you're quite a long time in some of these big schemes. If you can put a reasonable level of affordable housing in, then it has similar benefits that Angela highlighted on the build to rent in terms of capital, etc., to the developer. So there is a value trade-off clearly, but I don't think it's quite always the case that the developer's sitting there saying, I don't want to do, the investors don't want to do it. I think actually they particularly investors, they simply do need the numbers to work because they're pension investors. And they see that actually the time period and the outcomes from a social economic perspective can be really helped by affordable. I think it comes back to the viability point.
Thank you. And then Angela, I don't know if you want to add anything to that, otherwise I can hand back over to Assemblymember Garbett.
Not really. I mean, I haven't got a personal experience of dealing with the kind of investors that the two panel members are talking about, to be honest with you.
Okay.
So nothing else to add.
Thank you. Assemblymember Garbett.
Thanks. I was just wanting to raise some concerns a bit about Opportunity London and maybe discuss some of the other impacts to the kind of overseas investment that we've had for a while in London, and the kind of impacts that we were hearing earlier around kind of the increased rent, the inequalities, and those other impacts that it has in the area where development happens. The 2024 prospectus had a quote about Barking and Dagenham, and it said the scale of the opportunity is significant and forecast housing and rental price growth over 5 years in the borough is 22% and 16% respectively. And obviously that was like promoting a positive of rental price increases, and we know how devastating rental price, you were talking about the pressure on temporary accommodation. A lot of that is because of private rented costs going up and people falling out the end of the private rented market. Rented sector. So I just wondered if I could explore a bit about what Opportunity London's going to truly do for the affordability and the housing crisis in its broadest sense. I didn't know who wanted to start.
Yeah. So I think, I understand your point in terms of what you're saying and how a prospectus could be read like that. I guess what I would say is that, so let's stand back and go for an institutional pension investor, then they need the income that they receive off rent to grow at the rate that their cost base grows on paying out pensions. So growth is a fundamental part of kind of an investment position, because it's kind of balancing your liabilities with your assets. I think what therefore investors seek is confidence that the growth in the asset level will be in line with kind of what they need to pay out on pensions, etc. Most of those sorts of institutionals do operate in the same way. I think absolutely there is a challenge then in terms of if that is significant affordability and all of those constraints. But I think if you sort of, one of the things that we have a huge challenge on is if you can't, and I think, Angela alluded to it earlier, if you can't give an investor confidence that the growth rate is going to be where they need it to be, and I think you've experienced that in some of the RP world, then, they can't put the capital in because they're not sure that they can pay the pension bills out.
I guess my challenge is there any calculation to the council homes you get from that investment, but then, 10 years down the line when the rents have gone up by 22%, how many people then fall out of the private rented sector in the need for council homes, and therefore do you get any kind of net gain around affordability? I guess I'm just challenging the whole kind of not just getting that one home, but seeing it within the context of the pressure that it puts on, providing all the homes that we need.
So I think maybe just talking a bit about the process by which those things go into the prospectus in the first place. So those schemes are put forward by boroughs saying these are the ones to which we want to attract market investment, and then Opportunity London helps to figure out whether or not will that be based on what you've put forward. But Barking and Dagenham will have put that forward based on having a whole pipeline, some of which will be, and out of that whole pipeline, they'll be thinking through about their needs across their 10 years and everything. So that individual scheme might be framed like that, but what they will have thought through is what else is in our pipeline that we're making sure that we're producing an adequate affordable, social, those sorts of things. That's how they would have probably framed it. So I think judging their whole pipeline by that one scheme that they've put into the investment prospectus probably isn't quite right in that case. You're not wrong about that effect, though. I don't want to be glib about this. That's one of the tensions we're constantly managing in London.
How are you managing that tension? What does that look like?
I think some boroughs are pushing as hard as they possibly can. So quite often you'll hear right now Wandsworth used as the example as developers sometimes project that to me as they're being intransigent and difficult. Wandsworth would probably come back and saying we're trying to defend our residents' interests on affordable housing requirements. It's a difficult tension because, again, developers will throw back at me 0% of 0 is 0. So if we're not building at all because we can't make that money work, then you're not getting in affordable housing because we're not building anything. But I get, and it's not just one, I don't want to single them out. There's a lot of boroughs trying to say once a unit is built as non-affordable, it's never going to come back into affordable use. That's not how the market works. So that's the tension. Different boroughs will make their own calculation about how hard they want to fight and the risk they want to take that things just won't get built at all.
Thanks. Yeah, we were hearing it this morning, earlier on, about all the different mechanisms that other cities globally use to bring homes back into kind of social use. So, yeah, I think it's just good to talk about it in the round. So, yeah, thank you. Thanks.
Thank you. The next one's from me, and it's around, on a similar vein, in terms of delivery of affordable housing, what are the emerging public-private partnerships that you can kind of talk us through, if you've got any thoughts on that? And so we'll start with Piali.
This is probably the one where I'm weakest, to be honest, so I might have to turn to my two colleagues on the panel because I don't get involved in direct delivery.
Beck?
Yeah, so I think there's a couple of structures where we're trying to see whether we can get basically a scale pool of capital into London to sit behind a whole range of affordable housing. And the reason for trying to pull together a scale offering is then you need to basically go to relatively few investors for relatively few decisions. Also, that pool of capital may then be able to support a whole range of parts of London, and you don't need the skills, etc., to manage and kind of put that offer together in lots of places. You just need it in one or two, which is a real issue in terms of just, boroughs all having the skills to do it. That is, and you've probably heard this in evidence you've taken, and that is a model that is used elsewhere in the world, a scale investment model into a particular fund, and then that's then deployed over a range of locations.
And though that particular type of fund would be kind of open to focusing on affordable housing delivery? Okay.
Purely affordable housing. So not private. And because you do it as purely affordable housing, you target a very specific form of institutional capital. I mean, generally institutional capital doesn't like open market private sale housing, right? It doesn't like the risk profile. Institutional pension capital wants really stable, predictable return that comes off affordable housing. It doesn't want the price might be this, the price might be that. We might not sell them, we might sell them. It shies away from that. That's more developer capital. So all of the things, when we say institutional capital, principally institutional capital likes affordable housing, and it does also like BTR because of the similar reasons on the kind of predictability of return. So I think a large structured fund that I think maybe there's slightly some of Lord Bailey's earlier question in that around how could you make that work. Super funds, you kind of see these things in different terms throughout the world. We're looking at, and we have been looking for a while at, could you get that to work in London? because the prospectus from a London perspective is, good, global city, all of those things, entirely focused on delivering affordable housing and able to then kind of be able to deliver in places. I think that's a key part that just wouldn't get there necessarily on their own to get that fund structure there. The other things that I think you see a lot of at the moment are where RPs are struggling with capacity of funding, which I think there's been discussion of, and they simply just don't have the money to deploy in new affordable housing for various reasons. And I think RPs themselves are directly discussing with institutional investors over are there some structures that they could use to deploy more capital and effectively restock the RPs' funds to then be able to bring forward housing. There's a couple of things in there I'd flag. So you do see sort of JV type models around. Angela, there's a variety of themes on those. They're kind of one option. I think you also see options where, and there's not that many of them in the market at the moment, they're coming through, where maybe the institutional money will take out existing stock of the RP, and then that frees, by that receipt for existing stock, that frees new money to potentially then go into new stock from the RP. So, looking holistically at an RP portfolio, how could you best financially structure that with an injection of capital to free up more money for affordable housing?
Thank you. And again, Angela, I don't know if you had any thoughts from a Peabody perspective on the kinds of partnerships you have taken or others in your sector.
Yeah, I mean, Bex has referred to those, and I think some of the ones that come to mind from G15 are Hyde and Metropolitan's Thames Valley, who've got joint ventures set up with M&G, Legal and General, and AXA and Homes England. And some of those are active, and we're starting to see things coming through for those. Some of them aren't necessarily doing an awful lot at the moment, and I think that's possibly because returns aren't necessarily what they need them to be. It's something we've been looking at as an organisation. We haven't got a partnership set up at the moment of that nature, but it's something that we're definitely considering, and working our way through how we could do that. And I think there are other partnerships that could work as well, and we talk about the public sector, where returns are too low for private investors. If the public sector could join us as a joint venture partner by taking those lower returns to try and get a joint venture operational, and we see that as something that can unlock stalled development, particularly where it's unviable. And by investing, they can use that position to encourage private investment and building that confidence. So that's something that we'd like to see happen, and would support.
Thank you, Angela. So before we close, I don't know if there's anything in addition to what you shared today that you'd like to contribute to the committee. It'd be helpful to us, but if not, then, oh yes?
I probably would just make a couple of points about London's product in housing, and particularly affordable housing.
Okay.
Because it's a really common theme we get from investors. So you're probably very aware of issues over building regulations and heights. And that's got very much more pronounced, I would say, in the last 2 to 3 months, with new regulatory process and a lot, that finding its feet and being a challenge. But I think if you, for example, if you see in the regions outside London, affordable housing often takes the form of like single family, semi-detached type properties. Investors are very keen on those. And they're very keen on those because they view the risk profile as a lot simpler because you haven't got height and building reg issues. and they're also very keen on them because you don't have service charges associated with larger developments. And I think those things are a particular challenge when you're trying to get institutional, so we're talking pension fund, we're talking like good long-term capital into London affordable housing product. They see the challenge around nervous on the height, nervous on where all that may go, just a bit like, you know, if I could choose something else, I wouldn't choose that type conversations. And then also the economics, I mean, I started on viability, but the economics are that, you know, if you're on a sort of edge of town in somewhere in the regions, there's unlikely to be a service charge associated with that property if it's a semi-detached house, right? It is what it is. But in London, you may have service charge for the buildings, so the framework and all those things that needs to be done, but also you may be picking up estate charges. Quite commonly on big, large schemes, there'll be an element of estate charge for upkeep of common areas, you know, parks, all these sorts of things. And that is more money that has to come out of the cash flow. And so I think that definitely gets fed back really strongly from investors as being like, you know, it's just like more out of the cash flow.
Okay, thank you. Anybody else before we wrap up? Okay. Well, I'd like to thank the three of you for attending and for all of your contributions today. Can we note the report and today's discussion? Can we also delegate authority to me as chair in consultation with party group lead members to agree any output arising from the discussion?
Agreed.
Can we note the committee's work programme and the additional activity undertaken since its last meeting, namely the visit to housing for women's accommodation for women leaving prison?
Noted.
Okay, so the chair of the, the next meeting of the committee will be confirmed by the London Assembly at its annual meeting in May 2025. I have no urgent business and I declare this meeting to be closed.
This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority. Please stand by. This is the broadcast from City Hall, the home of the Greater London Authority.